Good day, students. My name is Dr. Cassim. I'm your lecturer for financial management. I will be putting on the videos, which will be slides and calculations. I just need you to know that this is but only a skeleton. The slides. You need to use the slides in conjunction with the textbook to be able to get the bigger picture. Some of you might ask, why financial management? Because it's very important, especially if you're going to be a business owner. Now, I just need to tell you beforehand that financial management is basically built on the foundation of accounting. I know and I'm aware some of you did not do accounting at school, so therefore it will be very imperative to follow the slides, follow the videos as we go along. One thing I need to tell you, I'm not here to waste your time, so everything I load on Vutela, you need to know that it is important. Another thing is the reps are also loaded. The contacts of the reps are also, class reps are also loaded on Vutela. So the link to the group is there as well. So please make sure that you go on Vutela daily because it will be loaded. Information, notes will be loaded on Vutela. So today we're going to do study unit 1. It's the introduction to financial management. The study guide has been loaded. Your textbook has also been loaded, a picture of your textbook that you need to get. Okay, so now, after we have done this study unit, it says at the end of the study unit, you should be able to determine the relationship between financial management, management accounting, financial accounting, economics, and taxation, of which you need to know. There is a difference between a financial manager and a financial accountant. There is a difference between a management accountant and a financial accountant. There's also a difference between a financial manager and a management accountant. So I think you can see where I'm going to with this. The second bullet is you need to understand the general acceptance accounting principles. We call it GAAP. Now, this is basically like a statute. It's like a constitution whereby rules and regulations, how accounting statements needs to be set up. The reason for that is that there's always uniformity. So if you want to compare, if your company is doing well, you need to compare it with another company. So it means that you need to use the same measurement systems, you need to use the same benchmarks. That's why we use the GAAP, acceptable accounting principles. That's a principle that most accounting practices need to use. And then you must be able to define accounting terms and financial management terms. Okay. Now the relationship between, you don't have to know this diagram. This is only for information purposes, right? So in a normal enterprise, you will get someone that does tax. You will get someone that does the financials. You'll also get someone that does the management accounting. Now when it comes to management accounting, the only time you'll have a management accountant is if you are a production company. If you are producing stuff, then that person basically is interested in what products should I keep, what products should I leave. They're interested in budgets, they're interested in the process. For example, let's say if you are a management accountant of iPhone, you will then be able to say, no, the iPhone 10, we're no longer going to produce it, right? We're now only going to produce the iPhone 14. So that's the responsibility of the management accountant. Let's say you a cell phone production, not only a specific brand. You will then say, the Nokia doesn't sell so well, so we're going to stop with the Nokia. We'll continue with the Samsung. That's basically what the management accountant does. The financial accountant that person looks at, is the company making a profit or not? Are we spending too much? Is our expenses too much this year than it was last year? If that's the case, then the financial accountant then needs to go and see why is that. And then you get the tax accountant. The tax accountant basically looks at everything from a tax perspective. Why? Because one person you don't want to owe is SARS. Financial management and management accounting. These are now the differences. Financial management, or a financial manager, his responsibility is to create wealth. How does he do that? He goes out and he looks at certain projects. So he'll come back and say, listen, I think we need to buy that building, and we're going to do this in that building, and that building will bring us an estimation of so much profit, right? So the financial manager goes basically to the future to go and look at a project that he wants the company to basically invest in. The other thing is how a company earns and spends its income. So when he identifies the project, he will then, or let's say the company has made a huge profit this year, and they don't want to just pay bonuses. They basically want to start a new investment. This is what the financial manager will do. He will go and look for the best possible investment for a company to invest in. He also looks at a company's current financial position, right? So you cannot invest if you don't have money. So he will look at whether the company has money, and if they have money, how to best spend it. Financial manager also does the valuation of a company's liquidity and solvency, right? Now let's see. Liquidity basically means how liquid is the company? How quick can a company convert an asset into cash? Solvency basically looks at if this company is still going to be a going concern next year. Will this company survive this year? And there he looks at whether my assets is more than my liabilities. Now when you come and you talk about an asset, right? An asset is basically everything you own. It's yours, right? A liability is everything you owe, right? So this is yours, and this is someone else. So they're going to see, do you owe other people more money than what you own? If that's the case, you are not solvent. But if you own more money than what you owe other people, let's bring it down to current, right? Let's say, for example, you want to register at the varsity, right? And then you owe, or let's say you want to, the varsity owes you 20,000, for argument's sake. But you owe the varsity 50,000, right? It means that you owe the varsity more than what the varsity owes you, then you are not solvent. But if you owe the varsity 20,000 and the varsity owes you 50,000, it means the varsity owes you more money. That is, you are solvent. The responsibilities of a management accountant, right? A management accountant basically just reports and records. They more product-based, determines a company's budget or forecast for sales and forecast. So let's say, for example, let's take the iPhone again. So the management accountant will basically go and see. If we start, or let's say if we look at an iPhone 15, right? How much will it cost? How much will we sell? So the management accountant looks at past information to be able to calculate present information. The financial manager only looks at possible future information. The management accountant is only interested in a product or a product line. So when we talk about a product, that would be an iPhone 14. When we talk about a product line, it will be all the iPhones. And a management accountant looks at the valuation of a company's productivity. How productive is a certain product? A financial manager looks at the valuation of a company as a whole. Now, the difference between a management accountant and a financial accountant. Management accountant just use estimates. Because a management accountant will then say, listen, we're going to produce 50,000 iPhones, right? We expect, because last year we had iPhone 13. You sold, or the sales were 45,000. Right? And we only produced 40. Now we're going to produce 5,000 more for a new product. Let me write this down. So let's say last year, 2021, right? You produced 40,000 iPhones. And let's say you sold all 40, but you still had 5,000 that you could have sold. People came to buy, but you didn't have any production, right? So you didn't have, for 5,000, you didn't have any phones. So the management accountant will say, okay, for 2022, we're going to produce more. We're going to produce 50,000. And remember, this was for an iPhone 13. So we're going to produce 50,000 iPhone 14s, and we expect the sales to be 45,000. Now, all these are estimates, right? It's expectations. So they use estimates, whereby the financial accountant uses past information. Financial accountant looks, okay, in 2021, what was my profit or what was my income minus my expense, and did I make a profit or a loss? Okay, so let's say they say my income was 50,000, my expenses was 55,000. That means I made a loss of 5,000. So the financial accountant looks at historic information. Historic, this is past information. Management accountant looks at estimates, they're just guessing. This is what we think you can sell. This is what we're going to make. This is what, so they basically just estimate. A management accountant, reports are generated, right? Either periodically, weekly, or monthly. But a financial accountant must set up financial statements every year, right? The management accountant reports are internally generated. That's only for management. So management will then say, okay, according to your figures here, we agree you can produce 50,000. Or according to your figures here, we agree, no. Rather keep it at 45,000, or rather keep it at 40,000, right? So the reports are only for management. But when it comes to the financial reporting, which is your financial statements, those are internally and externally. Those are for the investors. Those are even for SARS. Those are for the employees to see, is this company making a business, is making a profit. Those are for creditors, those people that need to borrow you money. A management accountant, reports are not required by law, right? But for a financial accountant, it is required and governed by a standard. So now an auditor comes in, and an auditor comes to check, did you set up the papers according to, remember we spoke about the GAAP, according to those principles. So basically that is what GAAP does. Okay. Then we have the economist and the taxation or tax accountant. The economist basically looks at, they study people satisfaction, right? Now what does that mean? As for example, they take a target area and they will go and check how many people, let's say in Van der Bijl, uses Colgate and how many uses Aquafresh. So if more uses Aquafresh in Van der Bijl, they will make sure that all the like the Pick and Pays and the Checkers, they will produce, or they'll buy more Aquafresh. If, for example, let's take the campus. How many students on the campus uses Vodacom and how much uses MTN? And how much uses Cell C? If Vodacom is the maximum, they'll rather put up a Vodacom tower. So they look at people's satisfaction, and that's based on people's wants and needs. And in taxation, that guy only looks at government revenue. Now, do you know that if you start working, you start paying tax? And that is the money that the government uses. Have you ever noticed that many a times on the news, right? And when people complain of our politicians always going to court and they say they're wasting taxpayers' money, that's what they mean. Because the income that government gets is actually from the taxpayer. The General Acceptable Accounting Principles, which is GAAP, this is an important definition to know, right? It's a set, meaning it's not only one rule. There's a few rules. That's an acceptable principle, standard, and procedure that a company and the accountants need to follow when setting up financial statements. So basically they're saying there's a whole lot of rules that need to be followed when you are setting up financial statements, meaning if I have a company and you have a company, we can't use different rules. Because at the end of the day, when we need to compare whether I'm doing well. Now, how do you compare if your company is doing well? You compare your company to peers. Now, what's a peer? A peer is a company that's been around for a long time. So, for example, let's say you want to open up a cell phone, a telecommunications company. You cannot go and compare yourself to the Pakistan guy that's two doors down. You need to compare yourself either with the Vodacoms, with the MTNs, with the Cell Cs, with the Telcoms, to know that you are performing well. Now, you cannot compare apples with pears. You need to compare apples with apples, and that is why there's one set of rules that apply for everyone. And this is basically what the General Acceptable Accounting Principle is. And that is all for today, students. This is theory, so familiarize yourself. And don't go and study it like a parrot. Try to understand it. Try to explain to yourself, okay, if this is a financial accountant, what should this guy do? If this is a management accountant, what is his responsibility? And please note that for the part-time students, the full-time students are also welcome. There is a consultation that has been allocated to you. You can just go and see on the introduction and management slides. Students, thank you for your time. Until next time. Thank you so much. Bye.